Hello again. It is time for episode 81 of the Long Only Podcast. Jerry, how you doing?
I was going to say I'm Jerry, but you already said that. I'm well.
And you're Jerry.
And I am Jerry.
You're well and you're Jerry. I'm Doug. And Jerry, we continue our march towards finding the perfect background for me.
So Doug is in our Hall of Fame right now. Those of you who have really good eyes can see there is a Harvard University degree in the background. That is not Doug's or mine's, or Doug's or mine.
I don't want the Harvard degree right now. So
right now, yeah, we thought about hiding that, but then I said, no, that's from another era. What makes it even harder, though, today is next to him is a Harvard seal for the MBA that our namesake Dick Taylor earned at Harvard. And it says Veritas. And I am saying, is it possible today to put Veritas and Harvard in the same sentence? For those of you that don't know Latin, what does Veritas mean, Doug? Truth. All right. We'll leave that alone.
Just check the headlines.
You know
what we're talking about.
If you have been asleep for the last few days, you're going to have to go back and look at the headlines from yesterday or the day before.
Ivy League degrees aren't worth what they were 3 months ago. And 3 months ago, they weren't worth what they were worth 20 years ago. So,
well, and considering that, I think that degree is from 1950 something. So, yeah, definitely isn't worth what it was worth back then. Let's leave it at that.
All right. And this week, we're not really going to do a market commentary so much because, those things are only necessary so often. Look at the market, see what it's doing. We're going to talk about suffering this week. Right, Jerry?
Great Catholic topic.
Yes, suffering.
It's all about suffering. There is a suffering component in the market these days, isn't there? This ties into things we've talked about many times, and I'm going to tie it into risk. I think there's this, unfortunately, misunderstood aspect of any kind of an investment, or for that matter, any business endeavor. There has to be an element of risk, otherwise it doesn't work. If it were so easy as to be right all the time, then almost by definition, that's not possible.
It's basically inflation. If there's no risk, all it is just the value going up more or less artificially, and it's meaningless.
Well, it's not possible. So the way investors are successful over time is to endure periods of suffering. And Lord, we've had a period here for the last couple of years that's been pretty rough. We just commented on in our core growth strategy, we've seen 7 times the same sort of bottom level hit, which I'm going to say is unprecedented in my career of almost 40 years. I don't recall a period where we had that type of activity where it would, 7 times virtually bouncing off of roughly the same level. I guess the technical people would say that's one heck of a bottom being built. Let's hope it is.
Some might say building a base, Jerry.
Some might say building a base, Doug's favorite phrase. But the point is, this has been a period of suffering with respect to watching portfolio values. I will interject in that if you just ran a business, which we always talk about, and our namesake Dick Taylor, whose references to Harvard are right behind Doug's head, would say all the time, it's about business. Make decisions based on business, not markets. If you're thinking in terms of business, you don't necessarily, first of all, you don't really care on a day-to-day, let alone second by second. You don't even necessarily care on a year-to-year basis what the value of your business is. You're just trying to run your business and you're focused on your business. If you had to look at the value of your business, you'd probably freak out. Same thing, same kind of comment that I've made about people if they had to look at the value of their home or their real estate holdings on a regular basis, like a second by second basis, which some people do. They check the value of their portfolio every day. I've said many times that I think the industry has really done a disservice in many ways by giving this 24/7, 365, second by second, millisecond by millisecond tick of every move of people's portfolio values. Because to reiterate another common phrase or statement we've made is, are you going to let 1% of shareholders value your portfolio at every given moment, or every given day at least? The answer is no. Are you going to let somebody else come and tell you what your business that you own completely, if you did own a business, is worth on every day? You're not going to do that. You're going to ignore that. It's noise. But it's almost as if there's this required suffering that you have to go through in watching these values. And you only make it worse, frankly, by being like that, by watching the values every single day. And I'm telling you, this makes for, and we've seen it, never name names, but we've seen it in clients who have made very bad decisions because they get so hung up on what's happening on a day-to-day basis. And even if that, especially when that's been going on for now 2 years, that seems like like forever. In the investment world, that's a nanosecond, really. It is. It should be. You should, and so but without that suffering, there's no way you can have reward on the other side. There's an old Zadig. I was going to say an old adage, and you'll know why I said it that way in a minute. There's an old adage that if you don't zig when the market zags, and vice versa, there's no way you can ever be in a position to do better than the market. And that's what any active investment strategy is trying to do, is to do better than the market, and sticking to the discipline, living through those suffering periods, knowing that it's going to be there, and just accepting it is part of the recipe for success. Ultimately, if you succumb to that, then it is the only recipe to success, because if you succumb to the opposite, then you're not in the game anymore. And I thought, long and hard, that there are certain personalities of folks that, maybe shouldn't be involved in the investment, in the investment world. And I think that's wrong. I think the only ultimate mistake is to not be involved in some form, because then you're really relegating yourself to Doug's point earlier, whatever the vagaries of inflation are, which inflation has been with us for so long now in the world of what we call fiat money, where it's purely the guessings of the central bankers that are determining value of money. So you're leaving yourself subject to that completely. And a great example, and we'll probably need to get into this more, is the happenings in Argentina. Anybody who's paid attention to the big political upheaval that's happened in Argentina, where I think it's safe to say for sure over 80 years, the socialist government there in Argentina has absolutely destroyed the country, and beginning with the destruction of their currency, where inflation has been running like 330 some odd percent. 40% of the population lives in poverty. In a country that was once in the top 10 of economies in the world 100 years ago. It was an envy of the world for its vast resources. Just goes to show that just because you have resources doesn't mean that you're going to be successful. Things can be messed up. So, getting off a little bit of the topic of suffering, but without...
Some might call it the California of South America.
Let's hope not. But without the ability to absorb difficult periods of time, success is virtually impossible. So let's leave it there. I think it's not so much a market related message today, but it is I think a solid message that folks understanding it and adhering to, the way that we would suggest that you live through that, which is to just take a breath, be centered, be still, let these periods pass, be focused on business. You'll come out okay. Actually, I think ultimately you thrive.
Constant sunshine makes a desert.